Clevin, and this is Brad Turpin.
Morning.
We are with Encompass Lending Group. We have an office here, so we're always here and here to support you and your clients any way you need. Encompass Lending is an independent mortgage company, funds everything in-house for the most part. We do a few broker things that are not in-house, but ultimately almost every product and program that your clients could need, including HELOCs and reverse mortgages and all that type of stuff. But today, we are going to talk specifically about bridge loans and construction loans.
Well, before we get started, I'd love to hear who you are, how long you've been with My Home Group, and really kind of what you're expecting to get out of this. Go ahead.
My name is Michelle Lovett. I'm not with My Home Group. I'm actually with, right now, EXP. We're switching brokers
I love it.
momentarily. And what was the next question? What am I aiming to learn?
Yeah.
New financing ideas.
Awesome.
Yeah.
Different ways to talk to your clients.
I recently had a situation where a lender did talk to me about a bridge loan. I didn't really get the gist of it. It was one of those really quick email, phone call kind of things, so I figured a little more in-depth would be great.
Absolutely. Well, we're happy you're here.
Thank you.
Perfect.
Yeah, hi, John Browning. I've been with My Home Group since, April. I'm very interested in this because I'm actually going to flip a house with a friend of mine, so another My Home Group agent, broker. And we found out it's a great little house, and he goes with kayak lending for like a construction loan, short-term loan. And that's probably what I'll do because it's, the expediency of the moment, but I want to learn more about this because I want to do more of this because I think it's kind of something I'd be very interested in.
Absolutely. Yeah. There's definitely value in having some different creative financing. More so just in the way that you can talk to your clients or listen into keywords of what it is that their needs are. Not that you guys want to know financing and be, masters of mortgage by any means, because you guys want to do real estate. But it's our job to give you those tools so that you can do better and more real estate. So.
Absolutely. And I think a lot of consumers don't really understand the options that they have. So being able to give them kind of that vision can encourage a lot of people to get into investing or buy that second home that they want or buy that bigger house without selling theirs or whatever their goals are. So we're going to talk a little bit about that today. So why do we need to understand creative financing? We do a variety of these classes on different types of loan programs and how to market them to your clients, but really just different market challenges, demand flexibility, and what have we seen in this market right now? We have a lot of people that are it's a lock-in effect, right? They have a 3% mortgage rate, they're not wanting to leave it, but their home may not suit their needs anymore. So what are their options, right? So we are talking a lot about that. With the high interest rate environment that we've been in for the last couple of years, it has deterred a lot of people from buying that may have otherwise wanted to because their home isn't meeting their needs. So
Landlocked.
yeah, absolutely. But as we know, people have life events all the time that make them have a housing change and make them have that need. So obviously we need more flexibility right now to allow people to find, homes that fit their goals. Financing is not one size fits all, and that's why it's really important that you have a great lender partner who has a lot of different tools in their toolbox to help clients, because ultimately if they're going to talk to a retail lender, they're going to have 5 products with very strict buy boxes, and the majority of those products are not going to fit a client need, right? Or maybe. With a company like ours, we have a lot of great different options, and we can really tailor what product that they need to their situation based on the tools that we have. So we really think that it's not one size fits all. There can be a lot of creative solutions, and if you work with somebody who thinks outside the box to offer those creative solutions, it can help you do more deals. And we can help you, what we're going to talk about today, the buy before you sell program, building or renovating, so kind of construction loans or remodel loans, and really how to move forward with confidence in the solutions that we offer. So we're going to talk a lot about these options.
Yep.
All right, you want to touch on this one, Brad?
Yeah, so traditional loans are, sometimes a challenge because it's just usual FHA, VA, conventional, USDA, which means they have to qualify under normal pretense with the ability to repay that loan. And if they're already in a home, right? As a lot of buyers are right now, because of that landlocked element, they might be cash poor and equity rich. And that's where the challenges really start to come in, right? Because now you're being forced to write a contingent offer, and that doesn't boast well with the sellers. They don't want to take a contingent offer. And so it ends up putting you at a real hard disadvantage. In addition to that, maybe they don't have the capital to fix up a home, right? In the sense of a flip. So, regular conventional financing isn't going to fix any of those needs, and they're not going to address any of those challenges, especially if it's a property that has a lot of health and safety issues. Now, a lot of people think, okay, FHA, we're going to get, blasted with the appraiser repairs and subject twos. FHA's gotten a lot better over the years, but there's still a stigma out there that, we don't want to use FHA, we want to look at conventional because it'll be a little more lenient on the appraisal and what the requirements are. But bottom line, all the agencies are all kind of coming together on one thing, and it's really health and safety. So, but that doesn't necessarily mean that it needs those items outright, right? Meaning health and safety will be required, but if the homeowner wants to spruce it up, wants to do cosmetic repairs, then what are solutions for that? And that's what we'll get into next. Even with self-employed people, there are other outside the box elements for, say, non-QM. So we can take self-employed people that might be challenged because like most of us, right? We cash flow and what we report to the IRS are two different things. And so that causes issues when you're actually looking at regular traditional conventional financing, because everything is going to be going off of what those tax returns look like. So when we actually look at it from the standpoint of having flexibility in the lending world, that's looking at using bank statements only. Maybe it's written verifications of employment with no taxes at all, so no W-2s. Maybe it's even going as far as doing a DSCR, which we held a class talking about those specifically for investors. And those are great solutions too, because that just takes the rent roll and compares it proportionately to the principal and interest payment, and then qualifies that property solely. So now you take a investor that has a whole portfolio of properties. We don't have to dive into what those other properties are doing. We don't have to look at the tax returns. So those are also some great solutions as far as flexible financing. And but we're not really going to be focused so much on the DSCRs. But please, if you do have any questions, we'll be happy to answer any of those.
Absolutely. So let's talk first about bridge loans. So what is a bridge loan? What is that? So ultimately, it is a short-term loan that bridges the gap between selling and buying. So it is a really great solution for those homeowners who have a family, they want to upgrade into a bigger home, but they need to sell their home first. They cannot qualify for the new home purchase without selling, and they don't want to have that period of where they sell their house and then they haven't found a new home yet, so they're in temporary housing, or they have to move twice or put their stuff in storage. So it's what it does is it allows them to start shopping at their leisure, find their dream home, move, and then sell their home on the back end. So it's a really great solution for that. What it does is it uses equity from their current home for the new home's down payment, and then it's repaid when the existing home sells. So it gives them a cushion to move at their leisure, get settled, get their house cleaned up, do any necessary repairs, get it on the market, and then ultimately that loan is paid when their old home closes escrow.
Yeah, and the first thing we think of typically with a bridge loan is usually hard money, private investor, high cost, high fees, high rate, which those do exist and they still are used today. But now we're seeing different investors coming into the marketplace because there is such a need for the bridge loan, a good quality bridge loan, and that's essentially what we have. We have a pocket of different investors that kind of fall in that middle range. So we're not dealing with conventional, we're not dealing with the hard money, but we do have those people too, because there are circumstances that require it. But it becomes a little better fit for people, so it's not so costly. Because at the end of the day, it is just a cost of convenience and cost of doing business for people to be able to not have to move twice. And for some people, that cost is just not worth it. They would rather move twice, which then makes life a little more difficult for everybody because now you have to wait. So this is a way that, helping you educate you guys so that you, being the point of contact with these people, can say, you know what, I've got a solution for you, at least hear everybody out. And now we can at least present the options so that they can make the best educated decision.
And obviously these are really important during certain market conditions, right? So during the pandemic, when you put a home on the market and there was 40 offers in an hour, right? That probably this wasn't as needed of a product. It really wasn't.
Right.
But right now, when homes are taking 4 months to sell or 6 months to sell, if somebody has a need where they have to move and they can't wait that 4 to 6 months to sell, this is a perfect solution for them. And we talk about that a lot, kind of what their motivation is. We really find out what the client's goals are and what's more important to them, cost or convenience, and we kind of weigh the options that way.
Yeah. Especially too, because with the lack of inventory we have, they might price their departing residence properly to sell it within a 30-day time period, but then what are the odds of them locating a home also? And that also drives that 6-month time period as well.
Absolutely. All right, so here's an example of a buy before you sell program. So this is a bridge loan example. So this scenario here, their current home is about $600,000. That's what it's worth, but they owe only $300 on it. They're wanting to buy a new home that's $700,000. Maybe it's an extra bedroom for their new baby, right? Or whatever the situation is. What the bridge loan does is it allows them to tap $200,000 in equity from their old home or current home for the down payment for the new home, because they don't have the cash reserves for the down payment, as a lot of people don't. And then what they do is when they sell the old home, the proceeds pay off the bridge loan in full, and they're in their new loan for their house. So I don't know if you want to go into further detail, but this is a common scenario that we see all the time, as the buy before you sell type scenario.
Yeah, and this is more of your, regular hard money, or an equity line where you're just tapping into the current home, run an equity line, pull that capital out, and then use that cash from their equity to translate into the down payment for the new home. So this is more pretty straightforward, and then we've got some other solutions as well.
Yeah. This one, let's talk
Yeah.
about.
So this one is essentially where we have investors that, because you still have to qualify people for the loan, right? So let's say that they did tap into their equity line of credit. Now we have to qualify them with that additional payment, first mortgage, second mortgage, and possibly even third mortgage, right? That gets challenging. So what this does here is a different solution and just kind of a way of looking at it. But what would happen is that by using the bridge loan on the new subject property, right, which we can go all the way up to 5% down or 95% LTV, that loan, it doesn't carry a mortgage payment. So essentially, they only pay that. When it gets paid off, all the interest is accrued on the back end. So now, if it takes them 3-4 months to make their payment, their departing residents, they're still going to have their payments on, and they'll keep current on those payments. But on the new residents, they're not going to have to worry about having to take care of their mortgage, right? So that's just a little bit different lending solution for people that might be, strapped, economically and payment-wise, where they don't have the extra residual income to cover all those mortgages accordingly. And so by doing so, it's essentially then wraps around into a cash offer. So we can actually generate an approval letter that says this is just as good as cash, and we can close in the 10, 14-day time period. And that allows them to be competitive in the market by being able to offer a little bit higher than what's asking or what's on the table, and be able to close quickly, which then is attractive for the seller. So if it checks all the boxes and meets all their needs, this is a solution to be able to get them into that home quickly, right?
It works, and as Brad said, it allows them to do, very fast. So offer gets accepted, we can close in about 10 days, and then they can list their departing residents, and get that sold, hopefully
Yeah.
as quick as
So they
possible.
can use this
depending on
time
the
period to move,
situation.
get situated, get the honey-do list going, and then be able to, get it listed, staged, and without all their clutter in the home, right? So just another offer out there and another way of doing things. And the beauty is that there's no payments made, and all the overall payoff just includes the accrued interest over the term of that loan, however long that it becomes.
And generally those, can be as short as 60 days or so, but as long as 18 months, depending on the product.
Yeah.
But it does give people flexibility, especially in markets where stuff isn't moving at all. So there's other parts of the country, we're still moving here pretty well, but there's other parts of the country, we've talked to people in, Oregon or parts of California where homes are sitting for 9 months now, right? So it allows them to have that flexibility and freedom and not have the burden of 2 payments in the meantime.
Yep. All right. Now this one is a little different. This one is actually based on people that are having trouble qualifying. Maybe they don't have the ability, they're already qualified up against their first mortgage payment, their departing residence. Obviously, if taking out an equity line would add to that debt to income ratio, that's not going to work. And they can't afford 2 payments to qualify for both mortgage payments. Maybe they have the capital in hand for the down payment, but this is just purely a qualifying issue, right? So in this scenario, what we would do then is we would provide a guaranteed backup sale contract, and one of our investors will actually look at their departing residence and determine what that home would sell for. And then usually, 85 cents on the dollar, they will give them or provide them a guaranteed backup contract purchase agreement. And so by doing so, then this investor will not count that debt to income ratio or that mortgage payment into their debt to income ratio. So what it really is it's a CYA for them. It's an insurance policy that if for some reason that home doesn't sell on the open market, and usually they have a 6-month agreement in that contract for them to sell it, because I'll be honest, our investor doesn't want the home. They just want to protect themselves, right? So they're giving them 6 months or 8 months to sell that home on their own, which then they would get their own top dollar. But if not, then they're agreeing to sell that home at a discount, because then at least now our investor can feel confident in removing that debt to income ratio from, yes?
Pardon me.
Yeah, no, please.
Is there a percentage point beyond which you don't need to qualify, like for the down payment, you don't need to qualify in terms of debt to income or any of that stuff, or no?
There's always going to be an element of qualifying with an ability to repay, unless you go true hard money.
Or
Yeah.
DSCR.
Yeah, DSCR.
Yeah.
The challenges with those is cost, like we talked about earlier, but also usually they want a lot more skin in the game. So rather than only coming in with 5% down, right, you're going to be probably more like 35% down. That's a big delta, and so when you're looking at moving up or moving down, and they might not have enough equity to pull that off, right?
I'm thinking in terms of like 50% down.
Or 50% down. Yeah, that's a large part of the private equity positions, and that's why hard money is so restricted, right? So now it can be great if you got somebody that just doesn't have any qualifying factors, but most people we can usually work with and figure out something.
Yeah, I mean, typically, we have a lot of products that are, asset-based qualification. We're able to use, different tax returns. They're self-employed ways, so they don't have to be a traditional W-2 borrower. We can do, asset-based qualification.
Right, asset-based is great too.
Strong.
Maybe they've got their money tied up in money market and investments, and they just can't tap it.
Exactly.
Right, especially with a lot of the snowbirds. But then we
Or
can
retirees.
or
we see
retirees.
that a
Yeah,
lot.
hello,
Yeah.
I mean,
Yeah.
I don't mean to be too personal, I'm just
No,
saying.
it's true.
Yeah, I have great equity in my home. I have, a good 401k, which actually I just turned into a rollback IRA I combined too. And I have a brokerage account. So there's resources, but for this year, I lost my job in February, and so I haven't really had any income since my thing ran out, the what they gave me at the end.
Severance.
Severance.
Yeah.
Yeah. Couldn't think of the word. But I'm fine financially and I have the resources, it just, and that's one thing I'm hoping to learn here is how to tap into some of that, like the IRA and
Yeah.
stuff. So,
So yeah, that would be an asset qualifier program. So
Yeah.
we can look at all of that and ultimately make an argument to the underwriter as long as you have enough in reserves to make your payment for 6 to 12 months is typically what they want to see. So whatever the payment on that property is going to be, do you have enough in reserves to cover it for
Yeah.
6 to 12 months with no income coming in is usually
And
what
then depending
they want.
on how much asset base there is, we can take that dollar value, and then, run that out over 36 months, because that seems to be the magic number for underwriting if they are looking at a payment,
Yeah.
to say, well, we can make the payment for this, and then we have these amount of reserves as well, and so then it's an approvable element. Right?
We've even done it sometimes or seen it where the underwriter just wants to see maybe a disbursement set up for temporarily. It doesn't have to be forever, but for the qualification period
Yeah.
where you have a disbursement coming from one of your retirement accounts to you as income on a monthly
Yeah.
basis for a few months in a row that we can show
Yeah.
that could continue. And then, once the loan is funded, you can turn that off, right?
Not
But
that
it's-
good, but yeah.
put
Yeah.
it back in, So there's lots of different ways that we can
Yeah.
figure out asset-based qualification. But again, I think your equity in your home might be an easier way to go.
Sounds like it, yeah.
Yeah.
Yeah, and that's what this does. This basically just removes the qualifying factor of the debt to income ratios out of the equation, and allows to bridge that gap so that then somebody can move up, move down, whatever it is they're trying to accomplish. And then, of course, once the home sells, that would then pay off the equity loan that was done on their departing residence, if there was one. But then it would also pay off the subject property, the new property loan, with, again, same thing, no payments made, interest accrued on the back end. And then at that point, then we would just refinance it into a regular loan, because then circumstances would change, give it 6 to 12 months, and those circumstances would be in line to where now we can do a regular conventional mortgage. Or maybe it's a step process. So maybe we do something like this to tap into equity to get in, allow for the easy move and the transition. Then we come back in with maybe an asset-based program or some other, non-qualified mortgage, more outside the box thinking before things then get lined up for a regular conventional mortgage. And we'll even use that scenario with people that need some credit help, because we do have our credit counseling team that will work with people for loan approvability and get them squared away. So while we're waiting for that to be worked on, then we might be able to solution it with this and then step it along the way, right?
Okay.
And have different scenarios that way. So it's ultimately it's all about the profile, and I can guarantee everyone in this room, everybody's different, just like our fingerprints are. No two profiles are alike. So to put everybody into the same box is a challenge. And that's the biggest problem with regular conventional financing or FHA financing, is that the rules that have now been instated is everything has to fit inside this box as a qualified mortgage. And that's part of the problem,
Yeah.
right? So that's really what this is, just different solutions along the way. I'm sure you guys heard the news about
Yeah.
Trump's proposal for a 50-year mortage.
I think it's interesting, yeah.
How do you guys feel about it? Good, bad, not so sure?
It's a two-edged sword. I think that it will help qualify a lot more people to be able to get into home ownership, which I
It
think is the
will.
biggest step you can make in life financially.
It'll definitely help in that element. The problem is that the amount of interest that's paid over that life of loan. So you take
But who pays a 30-year loan even?
well, nobody does, right? The average move time is 5 to
And
7.
you can always pay
years.
on your
Yeah.
principal if you start.
Agreed. So it is a great tool,
Yeah.
right? However, it's not as beneficial as everyone thinks. So example, a $400,000 loan is roughly about $300 a month lower than
Yeah.
a 30-year mortgage.
Yeah.
That's not that big of a difference. Now, that can make the difference as a first-time home buyer,
Yeah.
and that's where I do think it will be beneficial in some
Yeah.
cases, but for this end-all be-all fix, it's not it. Especially because, also keep in mind, and this is one thing that nobody talks about, is that we had 40-year mortgages before the collapse of everything in 08.
Okay.
And we had interest-only options. We had a lot of things that were tools that were allowing us to qualify people, right? Which is a large part why this now starting to change and evolve, because all that went away. And all that went away under Dodd-Frank Act, when that came in and re-regulated credit, financing, mortgages, banks, servicing, all of it. It just redid everything. And one of those terms as being a qualified mortgage is that it can't be more than a 30-year mortgage. So they're going to have to rewrite Dodd-Frank Act to be able to instate a 40-year or 50-year mortgage. We do have 40-year options already, but they're in a non-QM world, which then dictates a higher interest rate and some other challenges. So we already have that at our disposal if we have the right client. They're not available in a first-time homebuyer fashion like what they would try and do with a 50-year mortgage. So just something to consider and keep in mind.
Yeah, because sometimes you have motivations beyond just going out and making money. It's like, I would love to help young people. I've got 4 grown kids. I would love to help them all buy houses.
Oh, without a
And
doubt.
everybody else.
First, I have to reach to
Some
my
of them
kids.
are
My
doing
kids,
very well. They
they're at
still can't
college,
afford it.
and it's like that's the thing that they need to do. And where does that come from? I mean, honestly, if you think about it, right? Children start to get the basis. We're getting off on a tangent here, but you know, it's okay. But children start to get their basis of realization of renting versus owning in about what, first, second grade?
Yeah.
Is that when yours came home? That's what mine did. And they come home and ask, you know, do we rent? Do we own? Because school's talking about it. And here's the interesting part, though. When you own, you're proud, and you explain to your children why it's important to own your home. But when you rent, no parent wants to be a failure to their child, so they're going to poo-poo on owning and justify renting for various reasons. So now those children are going to grow up not thinking that that's the right way to go until they usually get to the main workforce out in corporate America and they're working with their peers, and then they see somebody that may be younger than them, might be less educated than them, and then now they buy a home, they go, oh, what is this? What happened here? Right? What changed? So there's a little dynamic in there that we as agents and in the real estate industry have to overcome, because you're dealing with some programming in some cases. And that's why all this is so important, because it's our job to your point, to help get that, be that advocate for the home ownership and be able to help educate people and push people to that path, because they might not know that they have the ability to go to that path.
Well, and it's the greatest tool to build wealth. I mean, ultimately,
Absolutely.
if you do a survey of millionaires across America,
They're all in
nine-
real estate.
every single one of them,
Yeah.
the majority of their wealth came from real estate. And I think that's what people don't understand is, while renting may be cheaper in the short term by a few $100s a month, if you look at your long-term financial goals, renting impedes you getting there ultimately. So that's where you have to show people from that angle that it's almost like a sacrifice now to gain later, right?
Yeah.
And you have to think of it that way.
And that's the one hurdle that I'm personally opposed to the 50-year for everybody, because if you think about it, you're going to pay, like any loan, you're going to pay mostly interest up front. That means that you're going to prolong building equity in your home, right? And that's going to put more people in a disadvantage when they need to sell and move up or down, because now when you add in seller fees, commissions, and everything else involved, they might end up being upside down for a longer period.
Yeah, God forbid we had, a more economic problem that caused homes to really decline in value like we've seen in the past. I mean, if people could be stuck upside down in homes for long periods of time, which thankfully we haven't seen that for a long time here, right? But there have been periods of time where that is the case, and then that's what, Brad is exactly right.
Yeah.
The interest up front, that part is brutal.
All right, so
yeah.
Ridgeland, let's get back on track.
Sorry.
No, you're good. Obviously, it provides stronger, non-contingent offers, accessing home equity without selling right away, smooth transition, being able to move, maybe even revamping that home, right? It gives them the power to do all these things. And of course, faster closings, which is what's important to you guys.
Yeah, another thing we haven't talked about that Brad just said. So, say that they are in a neighborhood where if they put a little money into their house, if they put 50 grand in, that they could sell it for 200 more, because there's a lot of that happening right now, but they don't have the 50 grand, right? This is a way that they could do so. And then ultimately maximize their current home's investment and the equity that they have there. So it really does give people a lot of flexibility.
Yeah.
Here's a couple considerations though of the negatives, or I guess potential things to consider. It is a short-term loan, so they're typically only 16 to 18 months. So with that, you know, it doesn't work for everyone. It depending on what their goals are and how far they want to move. So it's not for, we have people who, you know, want investors that want to do this and hold the home. It's not for that. It's not for that at all. Has a slightly higher interest rate, obviously. Requires sufficient equity in the property to be able to qualify, right, and use that equity. And typically, you know, depending on the product, we have some with one payment, like Brad talked about earlier, but the majority of them require 2 payments until the
Should be
sale
more
of
like
that
a
property.
home equity line of credit or a hard money loan. You know, those are going to require qualifying.
So you have to make 2 payments to forward funds? Is that what you're saying?
Yeah, yep.
Okay.
Yep. So, and that's
But remember, the new loan usually won't have one for 2 months, or
Yeah.
it'd be on the 3rd month.
Yeah.
So there'd be, but yes, typically it does.
and that's why the profile of the individual is so important. And we can figure out what's going to best fit their needs. Not only moving up, moving down, being able to capitalize on the property they want to move to, but also knowing their financial situation, so we can then recommend the best solution for them and present all options so that they can make the best educated decision for them and their family.
Here's one more example, and then we'll move on to construction loans. This is, you know, we talked about upgrading, the first example, people who want to move into a nicer home. This is a downsize strategy. So in this case, it's a retiree, they have a $900,000 home, they don't need it anymore, they want to downsize into a condo, but because they're a retiree on a fixed income, they're not able to qualify for both payments for both properties, so they need a bridge loan to buy the condo first. That gives them time to move at their own pace, maybe sell furniture, clean out their 40-year home, right, of things that they have. And avoid a rush sale or a double move. And it's really helpful for people, you know, especially, you know, the elderly community. It's that temporary housing disruption is really stressful for them.
It is, and they will actually sit tight because of that stress level and do nothing, which might be detrimental to them. Maybe they're struggling financially because they are, you know, so equity rich and cash poor. And I've come across, you know, some retirees that are struggling to even buy their prescriptions, but they're sitting to keep this home, right? And so one element to this too is we can even tap it into the equity, getting them that equity, and then using that in, say, a reverse purchase element. So, because now we're talking about retirement age, and hey, good morning. And in that retirement age, you know, they can use reverse mortgages. And so then we could set that up where, depending on the situation, again, profiles everything, but maybe we set it up to where they get a distribution out of their equity coming in
Every month.
No payment. And now it gives them the time to move, liquidate their estate, and then do the honey-do list, and then sell their home. So sometimes it's a fix-all for the retirees as well.
A lot of people we'll do another class on that, but a lot of people have really bad misconceptions about reverse mortgages, but they've been completely restructured and the guidelines have changed so much on those to protect the homeowners, ultimately so that there can never be negative equity or people going into a situation where they're underwater. But it's a really great solution for those people that are in that position where they have a lot of equity, but they don't have the income. And I think a lot of people are living longer than they planned now, right? My grandmother's 94, so she didn't plan to need income for as long as she has. So there are situations where it really makes a lot of sense.
Yeah, definitely. And the reverse element is a whole class in itself.
Yeah.
But what most people don't realize is that you know, it's all run by HUD now. And because it's HUD, it's one of the government agencies, so they set the guidelines just like our conventional world, and so everything is in place with algorithms and nothing changes. There's no room for changes or rearranges and anything that's going to put people at risk, and that's happened back in 2018.
And it can be purchase or refinance, so
Yeah.
a lot of people don't realize that too. So if someone's in a current home, they can do a reverse to refi.
Yeah.
Basically, so say they have a $900,000 home with, you know, $100,000 mortgage on it, they could ultimately refi that mortgage and then ultimately as income back to them every single month, tapping into that equity that they have. So it can enable people to have a lifestyle that they didn't have and live in a very nice position now, basically taking income from their equity in their property and go on vacations and travel and live differently than they have had they not used their equity in that way.
Yeah. And what we plan on having a class
Yeah,
on
we'll do
reverse
that.
mortgages after the first of the year. So watch the calendar for that.
Yeah.
Cool.
So now let's talk about construction loans. So what is a construction loan? It is another short-term loan, but it's meant for either new builds or major renovations. The thing that is most confusing about these, which we'll go into, is that the funds are released in stages or draws as the work progresses. So unlike most every other type of loan where you get, the lump sum of the loan at the beginning when it's funded, these are in stages, and it is monitored throughout to make sure that they're not overpaying as they go. And then ultimately it converts to permanent financing at the completion of the project. So we'll go into this in more detail.
Yep.
Yeah. Oh. Do you want to go through?
All right.
Yeah.
So this one is kind of on the same topic of which is our class, which is buy before you sell. So essentially, they located a plot of land, 150,000, construction cost 450, total 600,000. Most cases, 10% down is going to be a requirement in there. They will usually put a reserve to the construction cost just because budgets sometimes go over. So they always want to make sure and counter that. And essentially then, they would end up with 10% down, you'd end up with $540,000 loan, and, then that would get refinanced once the certificate of occupancy is issued. The land can be part of, we always get the question, do you do, lot loans or land loans? And the answer is yes, but it really depends upon the lot, the land, and what's happening with it moving forward. Meaning, if we use it in this situation, this makes perfect sense because now we already have plans, we have developed land, I can't talk today, and then we already have the construction blueprints, engineering, everything's in place. So they know what they're gonna get as a lender after everything's complete. But if we're just talking about a single plot, right, that we don't have a foregoing plan of build out,
Or utility access.
because you could have a $20,000 lot that might take $150,000 to make it buildable,
Yeah.
right? So that poses serious risk and serious problems. So again, that kind of goes back to every scenario is a little different, every plot of land is a little different, and we have to look at them as a one-off case by case. So we do have access to them, but in most cases, if it's that raw, they're not going to get financing. They're just going to be told you need to buy cash and then do your development, get it buildable, then we can introduce it because now we can introduce it into this world. But in a lot of cases, people want to flip lots and buy it raw, develop it, and then turn around and sell it, and they want financing for that. That is such a high risk element that element doesn't exist in financing world. That is purely just cash and capital, which if they want to do that, then we would look at what's their asset base, what's their equity base, let's figure out ways to get you that capital to do that. But I wouldn't recommend it for somebody that's just starting out because the risk level is so high. That's like buying penny stocks. We all know where that can go. So just something to consider.
With this one though, if it's a land in an established neighborhood or an infill build, I know I have a ton of these going on in my neighborhood right now. So there's a lot in Scottsdale. The whole Cactus Acre corridor, really, is all this is happening. So people are buying lots, they're building,
Right.
And they're doing, a lot of them are investor hard money, but we have done several of these for those where it makes great sense and it allows the people to kind of have the budget control of the build along the way.
Yeah, well, because they're buying it from the developer, right? Developer bought the raw land, subdivided it, got it presentable so that now it is ready to build, and that's why we're able to jump right in and then put a scenario to it. I've got a client in Tucson that's doing the same thing. We're actually going to start his loan at the end of this month, and everything should be complete in January. But he bought it over a year ago. It was actually, I think, September of last year. And because then once he got the lot, they were still working on the subdivision, so he just looked at, prelim plans, and it actually worked out into his favor because once everything was done, his lot actually ended up growing a little bit. So sometimes you can get some good deals getting in early.
Here's another example where someone wants to do a major reno. So they bought a $400,000 fixer-upper. They needed $200,000 for a reno budget. The construction loan finances both the purchase and the reno, the improvements, to ultimately get a final value of $700,000. So in order to qualify for this, though, we have to be able to show that the property with those improvements could appraise for $700,000. And this is where appraisal is really important, ultimately, and the comps in the neighborhood. If if all the homes are selling for around $700,000, it's really going to be no problem. But if there's only one home that ever sold for $700,000, and that was 9 months ago, we're not going to be able to get you that value to justify that much in improvements. And that's where ultimately they are going to be more cautious, because if there was any market correction, even if it's 5%, right, that can significantly affect the lender's investment.
Yeah, and you might have heard terms like Home Ready, 203K for FHA. All of these are kind of falling into this category. And what the thing to consider from real estate side is, to Liz's point, is always making sure that the home is being developed or renovated to the neighborhood. Meaning, if it's common for that neighborhood, people have already, converted lofts or converted vaulted ceilings into lofts, right? That's going to add easy square footage. Other homes have it, then it's going to be easy to attract or attack that appraised value, right, coming out of there. But if they're one of the first ones to do it, and they're doing a huge add-on that's taking up the whole left wing of the lot, and they're reducing their lot size, that could actually make that home functionally obsolescent. Or they're converting the garage because they don't use the garage, right? They're doing it for their own benefit in living in the home, but that could actually cause havoc on appraised value, because now that's the only home in the neighborhood that has that obsolescence, right? So this is where we want to be careful what the goals and intentions are overall. And a lot of times I've seen where somebody will come in with the best intentions, but ultimately then we end up falling short. And to this point is the appraisal. Because what happens in situations like this versus the previous scenario, appraiser's going to go out and he's going to appraise it based on that new build, square footage, everything tied to it with comps in the area.
And they already have plans
Right.
and all that, right?
Right.
With
This is going to be essentially two appraisals in one. So you're going to have an as-is value, what the home is currently valued at, and then the to-be-determined value, which then would be based on those renovations being completed, which then we would usually provide that whole list of renovations to the appraiser so that they could see everything that's happening. Maybe it's a kitchen remodel, bathroom as well, right? Maybe it's energy efficient windows. Those are all going to make valuable sense. But if it's enclosing a patio, there's not a lot of value add there, right? So we got to look
Even
at
pools.
pool's a huge one. You can spend 150 grand on a pool and you might get 30 grand in value.
At
Right.
most, yeah.
Yeah. So we got to be conscientious of what that's going to look like. And that's where, if this is a scenario that we're, resulting in, and this is where having a partnership and a relationship with your lender comes into play, because rather than just saying, yes, we can do it, and then paint your people into a corner, we're going to be coming back to you and asking your opinions on this and what this is going to look like and what you think, the market's going to support. Right?
Do they distinguish between improvements and repairs? Like, let's say you go to a house and there's, you need foundation work, or you
Deferred
need,
maintenance.
yeah.
They do. Appraisers will give it a condition code, and that condition code will be relating it to standard condition, an improved condition, and then subpar condition. And there's a couple categories in there as well. So you can actually have a decrease in value. So if you got an appraisal on that deferred maintained home right out of the gate, it would be less than market value of what regular standard condition would be. So now we have to look at, okay, well then that's our as-is. What's it going to be coming into it, right?
And ultimately, those maintenance type things
ARP,
really
yeah.
are not going to add much value to the property. Ultimately,
Yeah.
they have to be done. It takes value
Yeah,
away, but
yeah,
it doesn't
yeah.
really
And that should
add
bring it up to
value.
par.
Yeah.
That's
Yeah.
not adding value, and that's the hard part for consumers to understand. But it's also
Same thing with
a
like-
great tool if you're working with a buyer that wants to get a deal, right? Because now we can apply that same theory. They're going to get a deal for this property, and they might win. Might be just a feel-good win because the sellers don't want it to go to an investor that's just gonna profit. So you got a nice family that needs that home, you might be able to make the case and close that transaction based on that alone. And then now we've got the tools to give them to bring that value up, get the repairs done, and they don't have to come out of pocket. It's all part of the financing. So just another way to think outside the box and look at things.
So when to recommend construction loans if someone wants to build a custom home on a lot that already has utilities in a well-established neighborhood. This is a great product for it. If they want to do a major remodel or addition in a neighborhood that supports that value, right, like Brad was talking about. So if, there's neighborhoods with half-acre lots, generally those can always support.
Especially the older ones that only have a 1,400 square foot, 1,300 square foot home, because that's the way the homes were built back then. Yeah.
So
Right.
now,
So
you
now
can
you
build-
just tear it down, one wall up, so you maintain your tax base, and then you do a full rebuild around that one wall.
tear down or rebuilds, and then converting a fixer-upper into a dream home. So these are all good things or good options for construction loans. So if you do have a buyer that would be interested in potentially a fixer-upper but doesn't have the capital to actually do the work, this could be a great product for them, especially for somebody who doesn't need to move immediately, right? So if they're in a good situation where they're currently renting or living with their parents or whatever the situation is, and they can afford to wait a little while, this is a really great option for those people. And ultimately then, it gets them, obviously, well, not always, but generally it gets them into a better equity position initially, right? Because like we just saw in the one before, it may be a $600,000 loan for the purchase and the remodel, but then the value's worth $700,000 once it's completed. They're already walking in with $100,000 of equity because of that project. So obviously, depending on market conditions and neighborhood, that's variable, but it can put them in a really strong equity position right off the bat.
And sometimes it's also beneficial for the client too, rather than just jumping in and buying a resale that's already remodeled, to where we're going to close right now and they're going to have a mortgage payment that starts 2 months later, 1 month later, depending on timing and closing. This might be a solution for them because it gives them the opportunity to continue saving. Maybe they're expecting a bigger contract to come because they just finished their master's. There's so many variables that people have that this might give them the time needed to be in that better position. Because what will happen is that as the construction loans are financed and the draws are paid out, they only have to make an interest-only payment based on the number of dollars that are spent, not on the total loan. So that also gives them the ability to ease into that payment also. And call it 6 months or whatever that build time is. So just something else to consider.
Advantages to construction loans, as Brad just said, they're interest only during the build period, so it significantly saves the money based on the final value. The funds are managed through controlled draws, and this is really helpful because that way they're not like, oh, I want to upgrade this, and I want to do this, and oh, I want to do this, right? They are budget controlled the whole time on their build. It can be a one-time closing. We have several products that are one-time closes. There are others that are two closes. Meaning that we do the initial construction loan that's paid through draws, and then once it's completed again, that's when we actually basically refinance the construction loan and do it into a 30-year fixed loan at that point. But we have one-time products as well, and it can include land payoff, permitting, or contingency funds for additional reserves for overages on build estimates. So there's a lot of great advantages to these products. No, I'm running out of time here, so we kind of need to keep going. So here's a really good chart that kind of shows the differences between bridge and construction and when to use it. So the purpose, obviously, of a bridge loan, like we talked about, really the purpose of those is a buy before you sell type of a situation. Whereas a construction loan purpose is really to build or renovate a home. So different purposes for sure. The terms are also different. Bridge loans are shorter terms, typically 6 to 12 month period, where it gives them, they move into the new home and they have 6 to 12 months to sell their existing property. Construction loans, 6 to 18 months. We've seen them even longer, but that's generally the same. depending on permitting, right? That's where things sometimes are out of their control, that permitting can take a long time, so there's a little more flexibility with that. The collateral for the loan, for a bridge loan, the collateral is the existing home that they have. That's what the lender is using as collateral and the equity that they built in that property. The collateral for construction loan, the only collateral they have is the property under construction. And that's why the appraisal is so important. They're assuming that it's going to be worth X, right? Payment for bridge loan, there are possibly 2 mortgages. There's times when it's 1, like we talked about, depending on which product they go with. But they may potentially have to be able to pay 2 mortgages until they pay off until they sell their old property. Versus the construction loan, the payment is going to be those interest-only draws until the property is complete, so generally more cost-effective. And then the exit of the loan on a bridge loan, the exit is the sale of their old home. Once that sells, they're out of that product, right? And the construction loan, this exit is when it converts to a permanent mortgage upon completion of the property, and then that final as improved appraisal. So any questions at all on those? Kind of breaks it down pretty well.
Does.
All right, so here's some talking points that we think would help you. I don't know, Brad, you want to go through these? So these are ways that you as an agent can kind of help your clients see more options that are available to them.
Yeah, so let's explore options and make your offer stronger. Obviously when you're talking to them, it's just about looking at all possibilities. And by being able to refer them to a partnership or relationship lender, then that's where you can trust the fact that we are going to cover all bases, help educate them so that they can make the best decision for them and their family. Because hey, we can use your current home equity now, not later. Meaning we don't have to sell your home first, and so many people only know that to be the only option, right?
Or hard money, which they don't want. A lot of people
Yeah.
don't understand that there's these products. They think they either have to sell to get their equity, or they know HELOCs, but maybe they can't afford that second payment on the HELOC, or they think hard money, which is you're paying, way more in
Yeah.
interest.
Or you get we're just going to wait until we find the right property. And this can be a problematic scenario just because then next thing you know, you're getting your phone blown up because they just happen to find a property on Redfin or Zillow or whatever,
They
and
love
in their
it.
mind it checks all the boxes and it's the perfect home. And now we have to scramble, right? So this is a great opportunity for you to call your clients and engage with them, especially as we head into the holiday period, because what we do now affects us, 90, 120 days, right? So the more activity we can jump into now is going to set you up for the springtime, right? And this is a great opportunity. This is where you can just call them and say, hey, I know a lot of people are kind of poking around and looking. Markets are, volatile, but I want to be here and help you when that opportunity comes. In addition to that, I also want to make sure that if you are thinking about it, let's talk through it before we make any rash decisions or that perfect property comes up, because it's much harder to deal with. As you can see, we got a lot of moving parts. It's much harder to navigate through these moving pieces while they're when they're in that emotional state.
And we've seen that a lot, where people are like, oh, I think I want to do something, and then we got a call from an agent. We put an offer in already, and we're like, what? We haven't even pre-qualified them yet.
Right.
And so we had a situation where this happened, where they needed to use their equity from their current property for the down payment on the new one, but we hadn't even figured this out. And when we talked to them, we're like, hey, even if we did a HELOC, those funds have to be seasoned in your account for 60 days before we can close on the new loan. So it's like they ultimately, if you have a client that knows they want to buy and doesn't have the cash to put as a down payment, they have to start the HELOC or the bridge loan or whatever solution far ahead of time, because otherwise the underwriter cannot use those funds as a down payment unless they're seasoned funds, which is a government rule. That's not any specific lender's rule.
Right.
So
And
that's where,
because that's anti-money laundering laws. And the other part of that too is, as you guys have probably heard on the news, various news articles about people claiming mortgage fraud, owner occupancy issues. Yeah, and that is also another challenge when we get into tapping into equity, If we don't have the right tools in place and the right investor in place, then that becomes an occupancy issue. Because that means that we can do a HELOC on that departing residence, but now it needs to be non-owner occupied investment, because now they're going to claim owner occupancy over here on the new property. If they don't, now we just did 2 owner occupied loans that could be fraudulent. So we obviously want to protect our clients and make sure that they understand what's happening so that they don't paint themselves into a corner. Because with the ease of the internet, they can go log in, boom, boom, and put in a request for a HELOC. And although we don't recommend it because they don't ever get to talk to somebody, at least with us, they're always having communication and advice and in updates and so forth, right? But they have the ability to do that. So imagine somebody doing that and then getting this HELOC, and then now they have this HELOC with all this money at their disposal, and they now can't get a loan over here because they claim this is owner occupied. And they usually come with a stipulation, like any owner occupied loan is 12 months minimum. So they just paint themselves in a corner because what they don't know, they don't know. And that's where we come in, is to help navigate those waters and make sure that they understand the best way to approach something so that they don't put themselves at risk.
Depending on their home goals, everyone's different with that, their ultimate long-term goals. But it is risky, and that is what Brad said is exactly right. And a lot of people don't even think of that. They're either taking the money out as a HELOC for an improvement on the property in an effort to sell it, or as a down payment in an effort to buy. But as he said, if it's owner occupied, it's going to be real difficult to have them, to qualify them to purchase a new owner occupied with that loan just recorded. So we can talk about that through, we always get to know what their real goals are. And then lastly, if you have somebody who is looking at a fixer-upper or could be interested in that situation, you can build or renovate with one easy financing process. Because that's the thing. A lot of people think they can get a loan for the lot. They don't really realize they can get a loan for the full thing.
Yep.
So that is pretty much it. So ultimately, I know we'd love to partner with you guys. We do a lot of creative financing, and as Brad explained, we're amazing at really understanding what the client's goals are, educating them, guiding them. It's all no obligation. So what we would say is, if you have somebody who wants to do any of these products, have them talk to us way ahead of time. That way, when they do, I found the house I love, I'm ready to go, we can get it done quick because we've already kind of looked under the hood, so to speak. We have a lot of expertise on bridge construction and renovation loans. Local service, you'll deal with us, and we can close quickly. So we'd love to chat with any of your clients needing any of these solutions, and we can help guide them on the best thing with you, right? Because that's our goal, is to work together to help meet our clients' goals.
Any questions? So I know we kind of covered a lot.
Question. Are you aware of any program that allows IRA funds to be used to invest in real estate, like tax-free or any of that? Like, I see that all the time on the internet. Like, yeah, right. Are you aware of anything like that, or does it not exist?
Well, so anything that's IRA, 401k, you always got to remember that that's retirement age positioned, right?
Yeah.
So if we're talking personally, then yeah.
69.
Yeah. So that's where what you see on the internet is essentially different strategies. This is where I always say we're not attorneys, and I would always say to consult an attorney, a trust attorney on that, right? Because that's essentially their strategy is to, slam that money into a trust or an LLC, which there's different liabilities involved in that, in doing so, and then using that money to purchase properties. Now, not every lender will allow an LLC to own the property or draw docs within that LLC. It's usually still personally
Guaranteed.
to you,
Yeah.
right?
Okay.
We do have investors that will do it, but then you're going to pay a premium for that. So then it kind of takes away from what it is you're trying to
tax,
do,
yeah.
right? Because now you're paying a premium for your ROI. So you save money here, but then you're going to pay money here. So it's half a dozen one, half a dozen the other, and like anything, nothing's for free.
At some
It's
point,
probably
you
the
suck it
easiest
up,
way
pay
to
the
put it.
tax, and move
Yeah.
on.
Yeah. So a lot of times you end up spending a lot of money to get these entities set up and get everything running, only to have it really not save you much by comparison. So
Thank you.
that's probably the best way to put it, yeah.
Any other questions? Well, make sure you signed in. We're happy to send the deck out to everybody. And then if you have, we'll include our contact info, obviously. And if you have any questions, we're always here to be a resource for you. Even if it's not alone with us, we're always happy to answer
definitely.
questions.
Thank
Yeah.
you.
Second set of eyes even, you know.
Yeah.
If you've got through a relationship, that's great. We respect that and appreciate that, because that's what this industry is about. But at the same token, so many times that I find that we end up having a solution or outside the box thinking that somebody else didn't have. So we'd love the opportunity.
Yes.
Great, thank you.
Keep your eye out. We have a lot of classes coming up. I think we're doing one a week almost, through through right before Christmas, and then we'll start again after the new year. But and if you have any suggestions for classes, we would love that as well. Thanks for
'Cause
coming.
we just completed our open house.
Yeah.
We did ADUs a month ago.
That was a great class.
Yeah, so we'll probably repeat that one for people that couldn't make that one.
Yeah.
Great.
Reverses are going to come up. So, you know, there's definitely a lot of material to provide you guys on the lending side.
I'm sure you
And again, it's not the intention to make you guys lenders by any means, but if you're having dialogue with your clients and you're the initial point of contact, you need to have at least that little bit of education to be able to know when to say, because what you don't know, you don't know. And if you don't have those tools to be able to say, this sounds like a perfect scenario to talk to our lender, you know, and you're able to do that, and then let us go to work on that, then we can help you put that deal together, where if you didn't do that, you would have no deal.
Yeah.
So this is just another tool in the belt to be able to, you know, scrap up that extra deal a year.
Our goal is to help you get 1 to 2 extra deals a year through all of these, and it's pretty easy because there's a ton of people that want to invest in real estate, they just don't know how, right? And the DSCR loan, that alone, you should be able to get an extra deal a year easily just using that product, because there's no income docs to qualify. So as long as you do your due diligence and help them find a good rental in a good neighborhood that supports cash flow for rentals, and we get that rent appraisal showing that it equals the mortgage payment, that's all they need. You know, so I have so many friends who I would love to own an investment property, but until we sit down and explain it to them, they think that it's a lot harder than it is to get it.
Yeah. And to that point too, to what you were talking about, you know, as far as LLCs and trusts and so forth, those DSCRs will do an LLC, but only if you are the 100% owner of that LLC. They won't do it. So a lot of people go, we can do a DSCR, and then they get, you know, pool of investors.
And a syndicate.
Yeah. But really what is that? It's an LLP, because it's a partnership, even though it's under a corporation. And that's very difficult to foreclose on. So then lenders get really gun shy on doing that, right? Because you always have to look at it from the standpoint of foreclosing.
Yeah.
And everything that they do is always with that basis of protecting themselves as a lender. And even us as the direct lender, in normal circumstances, right? FHA, conventional, VA, you know, we're the in-house for everything. And then when we get to more of the obscure stuff, then we're playing middleman broker, which is why we try to have such a vast network of investors behind the scenes. But we're still liable up front. So that's why we go to great lengths to make sure we know the ins and outs of these things. Not only protect us, protect our investors, but then protect your clients too, because there's nothing worse than having a client go into something like a hard money deal or one of these other little more outside the box obscure lending options, and then a note being called due because somebody goofed on something. You know, and that's a high risk, high probable component in the lending world if it's done improperly.
Yeah.
So.
Well, thank
Great
you all. We
stuff.
really
Thank you
appreciate
so
it.
much.
Thanks, guys. We
Chinese
got food
for lunch from us and Charisse with Veris Title. So feel free to grab some. Looks like we have a lot of food out there.
There'll be some left for the next class.
Yes, enjoy.
Thank you.
And we're here to answer any questions if you need us.
Thank you.
Thank you.
This is the real nuts and bolts of the industry, you know. It's like you don't learn any of this in school. Or
No, you don't. They don't even teach us.
Really?
My kids just, you know, my daughter just finished college. My son's a senior at ASU, and You know, they don't even teach them how to balance a checkbook.
Oh,
Yeah, that's
right.
gone now.
Or how credit works.
Yeah.
I remember freshman year of college, they prey on you. Oh, sign
yeah.
this thing.
Oh,
Here's
yeah.
here's a free ticket to the
Yeah.
game.
No, I told my
Sign
daughter,
for
don't
a
sign
credit
anything
card.
without
Yeah.
getting with us. And then this morning we were just having, because she's in Colorado, she graduated CU